Hi everyone, welcome to this topic explainer video regarding the performance ratios. I am your expert tutor Aleena Kareem and I will be sharing with you a series of 3 short videos on the performance ratios. This particular video is related to working capital ratios. The 3 performance ratios that we are going to cover are working capital, liquidity and solvency ratios. Liquidity and solvency I'll be covering in different videos so that you can easily revise the topics whenever it is required. I'll be sharing tips and techniques regarding solving the interpretation questions, how to attempt them, what can you do to get the maximum marks, what kind of questions we can see in the exam, what are the meanings of these ratios, and what are the possible reasons behind the increase, decrease, or any kind of impact on these ratios. So let's start with the first set of ratios within the performance ratios, and that is working capital ratios. As I mentioned, we are going to cover working capital ratios first. Working capital ratios, also called the efficiency ratios, we are going to cover 3 major working capital ratios. Number 1 is inventory holding period. Number 2 is receivables collection period. And number 3 is payables payment period. The purpose of working capital is to talk about the overall liquidity of the business. Working capital is something which talks about the day-to-day operations of the business. So these ratios are very important because in individuality also they have their importance, but in totality they form the working capital cycle that we'll discuss in the end. And these are the ratios which ultimately talk about how well the cash or liquidity of the business is being managed in the day-to-day operations. So let's start with each of these ratios one by one. Starting off with inventory holding period. Inventory holding period has the formula of inventory divided by cost of sales into 365. This 365 is with respect to the number of days that we are taking into account. Please keep this in mind that the inventory turnover can be calculated in the times also, the number of times the inventory is sold. However, over here today, we are going to talk about the working capital cycle. So I'm going to calculate all of these ratios in terms of number of days. So this is the basic formula. Shortly, I will discuss the variations in it as well. This is for the finished goods that are there in a business. Mostly in our FR exam, we have seen finished goods being tested. However, there are certain other scenarios also. So over here on the screen also, you can see that there can be an analysis of the raw materials as well. So the raw material holding period. So that is going to be compared to the volume of purchases. Then there can be work in progress also that is going to be compared to the cost of production, and there can be finished goods which can be compared to cost of sales, just like we have discussed above. Now we will see what the inventory holding period means in general and how it can be applied to the exam scenario as well. First of all, the inventory holding period. It measures the average number of days the inventory is held in a particular business before it is sold. There are certain costs which are associated with the holding of inventory. So it is very important for a business to know for how many days they are holding the inventory before it finally gets converted into a sale. And that is what the inventory holding period tells us. A low value of the inventory holding period normally indicates efficient inventory management. Now, please remember that while you are doing the interpretation of financial statements, almost every ratio, whatever answer you get, there are positive aspects to that answer and then there are negative aspects to that answer. So you need to keep both perspectives in mind while you are discussing a particular ratio. So over here, if the inventory holding period value is low, it normally indicates that the inventory is being efficiently managed. However, there is always a risk that an order will come up, the sale will be made, and then we will not have sufficient inventory left in our storeroom to manage the future orders immediately. So there is a risk of stock out. On the other hand, when you're talking about higher values of inventory holding period, it possibly means that there is overstocking, or the inventory is a slow moving inventory and there is a risk of obsolescence. Also, there is a holding cost, there is a storage cost associated with inventory that is going to increase if the inventory holding period becomes very prolonged. So overall, we need to identify what type of inventory holding period are we dealing with in a question, and then we need to answer it accordingly. Please remember, these are generic points. I'll give you some specific examples from the past exam papers also, but these are the general points that you need to look for in your particular question. A very interesting point over here is that there is always a margin of manipulation or a margin of error also. Because when we say that you take inventory, normally we take the closing inventory. So the inventory which was there at the reporting date. That might not be a reflection of the inventory which was held in the business throughout the year. However, that is the value that we are going to take. So the year-end inventory value, whether it is higher or lower than the regular inventory which is being held, it may affect the ratio. In your case, please remember particularly that in your questions, you have to use the closing value of inventory always for your calculation purposes. Now, please remember over here, we are dealing with working capital ratios, which are going to talk about the efficiency of a company's operations. So inventory is a very important part of it, because we are going to talk about the analysis of the liquidity and the short-term financial health, and inventory is a very major part of it. Again, as I said, there are no absolute answers. In the ratio analysis questions, you always have to look at the context in which it is being discussed in the exam, and then pick out the points that I have mentioned over here on my screen and use them in the exam as and when required. Now, let's take a look at the exam questions which have dealt with inventory holding period in the past. Please remember, while solving the or giving your comments on the inventory holding period, you have to keep all perspectives in mind. Shorter period means lesser cash is tied up. However, it may mean that there will be too less inventory in the business, which may result in production stoppages or dissatisfied customers. However, long inventory period may mean obsolescence or a higher holding cost. Now, let's see how this has been tested in the past exam papers for you to understand. So, I have taken two examples over here from the past exam papers. I haven't included the questions, but just by reading the answer statement over here, you will be able to get to know what kind of contextual link you have to make while writing the answer. So I'll read this for you. Please take a moment and read this easily, and then I will highlight to you what are the main areas over here. So you can pause the video over here, read these statements to see how the points that we have just discussed are related to the exam questions. Now over here, they are saying that the inventory turnover figure shows that Minardi Group is able to turn over inventory more quickly than previously. Now this is the first major part that I would like to talk about. Whenever you are doing a ratio analysis, you have to make a comparison. That comparison can be with anything. It can be with an industry average. It can be with the company's own past performance. It can be with a competitor. There can be two options in which a company is looking to buy one of the options, and they are being compared. So anything can come up. But always, whenever you are discussing a ratio, it has to be compared with respect to a standard. And please remember to give sort of like a disclaimer in your exam, where you don't know whether what was happening in the previous year Was that a good benchmark or not? Or whatever is happening in the industry, it is a good benchmark or not? We assume that the industry average is something that we need to use as a benchmark. So over here, they are saying that the inventory turnover is now quicker than previously. Now, we don't know whether it was 70 days previously, now it is 65. The industry is doing it in 30 days. So it is quicker than before, but we don't have the complete detail. Now, in such cases, just give a disclaimer because the marker is going to assume with respect to what you are mentioning. Okay, so over here, they are saying that the inventory days are high, but the nature of the penalty group products will mean that they are not immediately perishable. So this is unlikely to be a significant concern. Now, this is a very major part. They are saying the nature of the products are such. Now, in case of inventory holding period, another point that you need to remember is that what is the nature of the inventory that you're dealing with? If it is a perishable item, then it is very important that it is sold more quickly. If it is a non-perishable item, then you have the margin to hold it for a longer period of time. So do not give any generic comments. I'm going to repeat this multiple times during my video because I cannot emphasize enough on this point that the answer that you write in the analysis, that has to be in context to the scenario. Writing generic comments is not going to get you marks. Okay. So over here, please see the inventory days are high, but the nature of the penalty group products will mean that they are not immediately perishable. So this is unlikely to be a significant concern. That's fine. But in exact same scenario, if the examiner had told you a perishable item, then the analysis would be completely different. So it says that in 28.6, the penalty group inventory turnover period would have included the figures relating to silver. Actually, this question, it had two consolidated financial statements. And also it had a discontinued operation. So you see, the answer is in context to the question, that they are saying that group inventory turnover in the previous year would have included the figures relating to silver, the discontinued operation. The removal of this seems to show that the inventory turnover period relating to cosmetics and fragrance is lower than that of the jewelry sector. Just by reading this, we get to know that silver must be in the jewelry sector. The remaining are cosmetics and fragrance. They have discontinued the jewelry sector. And now they are saying that cosmetics and fragrance have a lower turnover period as compared to the jewelry sector, which is why the overall figure is now better. So you see how each and every word is linked to the question. This is something very, very important. Then another example from another past exam paper is, this was Bun's company. In a company like Bun's company, it is expected that inventory would be turned into cash in a relatively short period of time. Bun's company is taking significantly longer than its competitors to sell its inventory. Now, because we are dealing with Bun's company, so this was a company which was selling items which were quickly perishable. So over here, it is a very big concern because the inventory needs to be converted into cash immediately, and it is taking significantly longer than the competitors. Which is being held on average for 17 days or 4 days as per the sector average. So there is a comparison with the sector average. The main worry, now please note this over here, I'll discuss the common issues that the examiner has identified and how to tackle them in the end of this video also. But the examiner repeatedly says that the students just state the numbers. Now over here, please see that the numbers have been given, but they have been given in the context of the scenario. And this is something very important. The main worry is that the inventory is largely perishable. It may be that since the acquisition of the brand, Bun's company pursued a higher pricing strategy, but this may be having a detrimental impact on the company's ability to move its inventory. Now, in this case, there was an acquisition during the year of a brand. Now, because of that brand, they have a different pricing strategy, and because of that, maybe the sales have gone down and the inventory is being sold more slowly. So you see, rather than giving, let me take you back over here. These were completely generic comments. This is only for your understanding of the possible scenarios that may come up. However, over here, you can see these are very specific to the questions scenarios. So make sure that you go through them properly and understand how the analysis is being done, because this is what your examiner is looking for. The examiner repeatedly says that the students just quote the numbers and they don't relate the answer to the scenario. So this is how you have to do it. So this was all with the inventory holding period. Now we are going to move towards the next working capital ratio, a very important one, and that is your receivable collection period. Now, your receivable collection period shows you the time that you take to collect money from the receivables. We have its formula, trade receivables divided by credit sales into 365. We calculate this once again in terms of number of days. Trade receivables are the receivables that have been generated from the sales of the business, the day-to-day sales or the operations of the business, and they're compared with the credit sales. If in your exam you don't have the figure of credit sales available, then you can deal with the total sales also. So this is a very important aspect because we get cash from the trade receivables, and that cash can be used for the liquidity of our working capital cycle. Now, we will discuss the individual points of receivables collection period first, and then we'll move on to an example from the past exam papers regarding this. Now, in terms of receivable collection period, they measure the average number of days a company takes to collect money from its customers. Now, this is an average number of days. Once again, the comparison is going to be with some other company or an industry standard, anything. While evaluating it, there are multiple aspects which are related to it. First of all, it being that shorter, if we talk about in a very generic sense, then shorter periods may indicate efficient credit control. So it may show that you are quickly receiving the money from your receivables. It also may mean that your customers, they are availing discounts. So you have offered settlement discounts or you have given a promotional pricing. So that is something which may reduce your receivable collection period. However, it may mean that it may reduce the revenue as well as the gross profit percentage. This brings me back to my point that I discussed earlier, that there are positive as well as negative aspects of every ratio. So you need to identify over here that what are you dealing with. So a shorter period on one hand is good, but on the other hand, it may be something which is getting lesser cash into your business. You can see in this formula, trade receivables and credit sales. We're not talking about cash anywhere. So yes, the receivable period may be lesser, which is good, but that may mean lesser sales or lesser collection of cash or a lesser gross profit margin. So we are saying that if you pay early, you need to pay lesser. So that is something which is linked over here. A very good way of analyzing the ratios is that you talk about the analysis of the numerator as well as the analysis of the denominator. Now, another aspect that may be linked to the receivable collection period is that shorter periods may mean that there are irrecoverable debts. So the receivable time period, you are very sure that your customer is not going to pay, and therefore your amounts are being written off. So the sales are there, the receivables are getting lesser. However, there is an additional expense for your business. For this particular purpose, it is very important that you compare this with the operating profit margin also. So a good analysis would be something in which you compare ratios with other ratios also, and the ratios with other figures in the financial statements as well. Then, longer receivable collection period, it may mean that there are credit issues or there are very weak collection policies. So your department is not good, which is doing the credit control. But on the other hand, it may be something deliberate. So there has been a change in your customer base, and to to target a new kind of customer or to attract new customers or to increase your customer base, maybe you yourself are offering a longer credit time period. Although for liquidity purposes, the faster the money is collected, the better it is. However, the longer the customers are given to pay, normally another aspect that is linked to it is that there may be higher levels of irrecoverable debts. So that is also a negative point. However, if you pressurize a customer too much to pay you early because you have a fear that it is going to turn into an irrecoverable debt or something, then it may mean that you may lose that customer the next time. So it's a very sensitive area where you need to follow up also, you need to pressurize also, but you need to retain the customer as well. Now, acceptable levels of receivable collection period, they vary by industry. So cash-only retailers, they have no trade receivables, but this is a norm of the industry. And then there may be certain industries in which everything is being done on a credit basis. Also, please see that the changes in the receivable collection period, they should always be assessed in context and linked to other ratios like gross profit margin, operating profit margin, or items in the financial statements like revenue. As you know, the receivables are directly linked to sales. So revenue is something which is directly impacted. This linkage, if you create that, that is going to help you a lot in scoring of good marks. Now, let's move on and see an example from the past exam papers in which we are going to see how the receivable collection period works. Once again, I have discussed the generic comments over here. In this next slide, we are going to talk about the particular example from the past exam papers of how this receivable collection period figure can be linked to the scenario and discussed in the context of a particular scenario. Now, taking an example from the past exam papers where we saw the receivable collection period question, let's see that it says that an increase in trade receivables is perhaps expected given that Smooth Company is a service-based company. This is likely to be due to Smooth's customers having significant payment terms due to their size. Now, in this particular question, they had mentioned that Smooth Company was a service-based company. So the inventory part was already not there. The receivable aspect that was more related to the services. And also the customers, they were very few, but they were very significant. So because of their size, they were very significant. And in such cases, normally, we try to give the terms because when you have lesser number of customers and they are very important for the business because they give you very huge orders, then you are flexible in terms of collection period as well. So this is something which was mentioned over here. Again, I want to highlight, giving generic comments in the exam is not going to help you. You have to make sure that your answers are very focused to the scenario that is there, and which is why I have taken these multiple examples so that you are able to handle this even better. Now, once again, it says that this increase in receivables collection period could mean that Smooth Company has a weaker cash position than Duke Company, while the size of the customers may mean that there is little risk of irrecoverable debts. Smooth Company may have a small or even overdrawn cash balance due to this long collection period. So their collection period was very long. However, because of the size of the customers that they had and the relationship that they had, because of that, the chances of them becoming irrecoverable was very less. So if any of you would just see a longer collection period and write without thinking that, oh, it is a negative point and this may mean irrecoverable debts, that's not going to get you marks for this kind of question. Why? Because the nature of the question is such that despite having a longer period, the risk of irrecoverable debts is lower because of the relationship with the customers. So I hope this is clear to you now. Now, here we are with the last and final working capital ratio, which is again something very important because it relates to the people who we have to pay money. So this is the payables payment period. Now, the formula for this is trade payables because we're dealing with working capital over here. So we're dealing with the regular operations of the business, so trade payables. And then the comparison of it is made with the credit purchases because trade payables arise when we do credit purchases. Now, one thing that I would like to clarify over here is once again multiplied with 365 to get the answer in number of days. In your FR exam, the credit purchases figure may not always be available. Trade payables would be available because you can pick them up from the statement of financial position. However, the credit purchases figure may not be available directly. In this case, if the credit purchases are not available, please use the total purchases. Even if the total purchases are not available in the question, then you need to use the cost of sales. Okay? And the trade payables, they are the figures which are there on the last day or which are there on the reporting date. So any aspect which is dealing with the reporting date figures, you are always going to give a disclaimer about them, be it inventory, trade receivables, or trade payables, that we are assuming that this figure is reflecting the level of trade payables throughout the whole year. Okay, so these are the payable payment periods. Now let's discuss what payable payment periods actually mean. They indicate the average time taken by a company to pay its suppliers. Now, naturally speaking, everyone likes to delay making the payment and retain the cash for usage anywhere else in the business, maybe like for payment of certain bills or maybe purchasing more inventory. So a higher value may indicate good cash management. However, excessive delay could harm the supplier relationships. So yes, as much as the delaying the payment is good, however, it may mean that the supplier will not give us the same kind of credit terms in the future, or they may assume that we are suffering with the liquidity issues. Decreasing the holding period, that could also occur, and that may be if the company is availing supplier discount. So there is a positive aspect to it also. If the payment time period is decreasing, maybe the supplier discounts are being availed, and that is ultimately going to increase the gross profit margin. So once again, because the cost of sales are going to go and hit the gross profit margin, so you are going to create the linkage over here again, that whatever the decrease in holding period is, if it is because of the supplier discounts, then the gross profit margin is going to increase. So if that aspect is good, then we are happy to deal with the payables payment period decreasing a little as well. So once again, it comes back to the point that everything has to be written in a particular context. And if that context is there, then automatically it is something that we say that it is acceptable for the business, or maybe it is as per the norm of the industry. Now, over here, we are going to move towards another example, which is there from the past exam papers as to how payables payment period has been dealt by the examiner in the past exam papers. Now, let's see some examples. Now, over here, we can see the trade payables from a past exam paper question. It says that the trade payables days are 67 for Fit Company and 29 for Sporty Company. So this was a question in which one company was a premium store for sports and the other was selling through departmental stores. They were talking about the sale of a particular division. So over here, they are saying that one company had the trade payable days 67 and the other one had 29. This is consistent with the fact that Fit Company has a much lower cash balance than Sporty Company. Now stop over here. Again, see how the analysis has created a link between the trade payables balance and the cash balance that is there in the statement of financial position. So once again, please make sure while you're doing your analysis, create a link between the figures. If you do that, that's going to get you like full marks. So this is a very good tip, that always link the ratios to the figures in the financial statements or to the other relevant ratios also. But yes, it has to be very relevant. Continuing with the statement, and shows that Fit Company are unable to pay suppliers quickly. So now this is a problem, that they have lower cash balance and it is being reflected in their trade payable days also. This could lead to future problems with suppliers and shows that the company needs to monitor its cash balance to ensure it can continue to trade in the long term. So this was a relatively straightforward analysis. However, if you had missed out this cash part, the marks would have been half. So just by linking it to the cash balance and showing the kind of trouble that they are in, we create the linkage and we get full marks. Now, we have covered the three aspects of the working capital cycle. Now it's the time to see how they work together in collaboration with each other. So very importantly, the overall final figure that we need to calculate is the working capital cycle. In case of working capital cycle, we first have to take the inventory time period because this is something in which our cash is stuck. Then we have the receivable collection period. Again, we've made the sale and our cash is stuck. It's a receivable period, so it only talks about the credit sales. And lastly, payables payment period, where we have made a stop to the cash that we have to pay to someone else. So this is something that regulates our working capital cycle inventory days plus receivable collection days minus the payable payment period. So all of this together is going to be calculating our working capital cycle. A shorter working capital cycle, it actually means that quickly the cash conversion is taking place, and normally it helps in the liquidity of the business. But once again, please be very careful about the figures that are there in the question, and very importantly, the one-off events that are happening in a business. So at times there is a lot of cash. Why? Because a disposal of a unit has been made. Now, this is not something which is going to happen every year. So while you are doing the analysis, please make sure that you are covering all the possible aspects related to it. So now this is all with our working capital cycle. Now let's move on to the study hub, which shows a particular question related to this. I want to create the linkage because there is study hub has a lot of text related to these ratios also. Once you've listened to this video, I would recommend you go back and study the study hub as well. Now, let me show you where it is in the Study Hub lecture notes. Here we are in the ACCA Study Hub to see the linkage of our topic with the Study Hub. In the chapter number 26, we are going to talk about analysis and interpretation. As you know, analysis and interpretation is a compulsory part of your financial reporting exam. So it is very important to understand it from all aspects so that you are ready to attempt any kind of question. Now, in case of the interpretation of accounts, we can see that different types of ratios are being discussed over here. For us, we are going to focus on the performance ratios. Within the performance ratios, there are multiple categories which talk about the different ratios and their trends. Here we are going to look at efficiency ratios that we have just covered. You can see there is a description with respect to what an inventory holding period is, its formula, its components, and the possible reasons of increase and decrease mentioned over here also. Then we have the receivable collection period. A same kind of approach has been taken over here as well, that it first defines what a receivable collection period is, talks about the formula, what are the possible items which can affect it, and the causes for increase and decrease. And lastly, we have the payables payment period following the same approach. In the end, we have the working capital cycle, which is summarizing all three of the above ratios. Here we have a question also which is dealing with both manufacturing sector and the retail sector. It has given us inventory holding period, receivable collection period, payables payment period, and the working capital cycle overall. Now, when we have the overall working capital cycle, we need to evaluate it also to identify if any company that we are dealing with, it is achieving optimal level of working capital cycle or not. If not, then what are the possible factors for it? So some factors may be beyond management's control, and you have to write it in your answer that this is not something which is within the control of the organization. However, in some cases, a controlled situation can be established. However, it is first important to identify the reason behind a working capital cycle which is a cause of concern for us, because there may be over trading, there may be over capitalization, there may be unreliable supply chain sources which are impacting the inventory levels, and it may result either in over trading or in over capitalization. Where there is insufficient working capital, we also need to identify that what is the reason behind the inefficiency. Is it because of a market factor, or is it because of some approach which is being taken by the management? At times the question gives us hint about a wrong approach being taken by the management also. So all of these are going to be covered, because ultimately this is going to impact the efficiency and the liquidity of the business. Now let's move back to our slides and cover the remaining topic from there. Now we are going to see how you can attempt the exam to secure maximum marks in the interpretation question. Interpretation is going to be a compulsory part of your section C of the exam. The questions can be different, the scenario can be different with respect to whether you are dealing with two individual companies' data, one company's own past performance, or you are dealing with one individual company accounts, one consolidated accounts. There can be a disposal of a subsidiary during the year, there can be an acquisition of subsidiary during the year, or any kind of major accounting impact. Now, when you are in the exam, the whole focus should be how to write your answer to get the maximum marks for it. And for that purpose, I will give you a 3-step rule. Number 1, state. Number 2, apply. And number 3, conclude. You have to follow this for every ratio that you are dealing with. Why am I focusing so much on it? Because it is going to be there in your exam for sure. Interpretation is going to be there, and unfortunately the examiner normally says in the examiner report that this is the worst attempted area. The tricky part is that the students do not even attempt it. They just calculate the ratios at the maximum and then they don't do the interpretation. Interpretation is very easy, trust me. There is a lot of subjectivity involved in this part of the paper. So you can, as long as you are able to justify your arguments, you can get marks for it. And the students who struggle with the structuring of answer, this slide is particularly for you. When you are writing the answer to a particular ratio, follow this 3-step approach. State, apply, and conclude. SAC. So in state, you tell what the change in the ratio has been. If you're talking about an increase from the previous year, a decrease from the previous year, or an increase or a decrease from an industry average, from a past performance, so state the change which is happening in the ratio. Once you have done that, then apply that change or justify that change through the scenario. Now, this apply part is the most important part of your discussion, and it has to be relevant to the scenario. Please do not give any random justifications. The random points are for your understanding as to what can be the possible reasons of change. When you are applying the ratio to the scenario, you have to pick up points from the scenario which can impact your answer. And the best approach in this regard is that see the numerator, see the denominator, the factors which are attempting the numerator, write those down. The factors which are attempting the denominator, write those down. Everything you can pick up from your question. So every word of your exam is relevant for your answer. Pick that up and write that down. And then conclude it. In conclude, basically, you have to tell what the impact of this working is going to be for the company at present and for the future also. So this is a comprehensive way in which you can get the marks which are allocated for the interpretation. So use this 3-step approach, write the change, then write the reason for this change which are possible from within the question. From within the question also, some reasons you can pick up from the figures that are there, increase or decrease, and the other ones you can pick up from the points which are given in your question. So let's suppose you are dealing with receivable collection period, you are dealing with the revenue part also, you are dealing with the receivables figure as well. So individually also analyze them and then look in the question if there is something which is talking about moving towards cash sales or discounts or any such thing, or any competitor related tactic which needs to be used. So apply all of that and then conclude it and say that if, for example, the company is relying on one customer a lot, what are its implications for the future? So if that company is asking you to give them more credit period, then automatically the overall working of the company is going to change. So use this 3-step procedure and apply it to your questions. Here is an example from what we have covered earlier. I wanted to show it how you can apply this state, apply, conclude rule. Now the first line of this, that the trade payable days are 67 for fit company and 29 for sporty company. This is where you are stating the ratio. Then it says this is consistent with the fact that fit company has a much lower cash balance than sporty company, and shows that fit company are unable to pay suppliers quickly. So from the question you pick up the cash point and shows that you cannot pay the suppliers quickly, link it to the cash shortage point. What is then the conclude part? This could lead to future problems with suppliers and shows that fit company needs to monitor its cash balance to ensure it can continue to trade in the long term. So this was a very simple example. There can be more points also, but simply state, apply it to the scenario, find the reasons from the scenario, and then tell what are the possible implications of it for the business. With this, we come to the end of this first video of the performance ratios, which was related to working capital. I hope you have found these useful, and please go through the other 2 videos also. I have covered the tips across different videos so that no single video is very long. So best of luck for your understanding and for writing the answer in your final exam. Please practice writing the answer a lot using these rules and using these figures, and you will be able to easily solve the questions in the final exam also. Best of luck. Thank you.